Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, April 18, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And I thought today was somewhat of an interesting day, but maybe not by most definitions. So let me kind of give you my thought process. So the markets were down across the board. They were down much earlier than they finished the day. However, I'm looking at a couple of specific things, and I just want to bring them to the forefront. Some of them may mean something, and some of them may not, but we'll find out as we go along. So what I want to do is go back to the 21st of March, which was a pretty big down candle. That means we had volume in this candle. We had 133 million shares. So we had institutional participation on the sell side that day. Ever since then, we've really been just going back and forth inside that red candle. We never got to the high. We tried it one time and failed. And what I want you to notice now is not only are we below the moving averages, which is bearish in and of itself. Now, you know I'm looking for a low, and that's not changed. I'm just saying, here's what I'm looking at today, and what may play out over the next few days is possible. So the low of this candle was 233.58. So we're not going to use that as an absolute number, but what I'm going to do is I'm going to draw a line at 233.58. All right, so now we have a point of reference. 233.58 is this black line that runs across. Now, what you'll notice is that we've either attacked, touched, pierced through, or closed above that line, which is pretty much everything under the sun. But we seem to be fighting that line almost on a daily basis for the last 3 or 4 days and the 3 or 4 or 5 days since we hit that line the first time. We traded away from it, but now we're back to it. So we hit it. We didn't hit it the other day. We closed below it yesterday. We were around it yesterday and closed above it. And today we were back and forth and closed above it. Now, I'm not suggesting that that line is an end-all, be-all, or that number, 233.58, is an end-all, be-all. I just wanted to bring to our attention that the longer we hover around that line, if we begin to close below that line, I think that's another ominous sign for the market that we're going to have to go down and test some of these lower numbers. Now, it's easy to take a look at the market and say, all right, well, look, we had a down move, and we're really just trading in a bearish formation below the moving averages. We should have another down move. And on one hand, that is correct. Normally, that is the way it works. We just haven't had that secondary down leg to satisfy the completion of this pattern. And maybe that still is in the cards. I thought we would have found a low by now. That hasn't happened unless we found one 2 days ago. That's still possible. But I don't think today's close was relatively good. We didn't have any follow through from yesterday, and we remain below the moving averages. I thought we would have traded at a minimum today up into the moving averages, specifically the 50-period moving average, and we didn't even make an attempt at that. And that has me scratching my head just a little bit. We remain in the time zone for a bottom. However, nothing happens on my time frame or your time frame. It happens when the market decides it's time to happen, and our job is to do the best we can at analyzing the evidence that's in front of us and trying to determine the most likely scenario. And that's what I'm doing here. I'm trying to determine where this market is going to find a bottom. And, you know, all things to me continue to lead to more downside the more I look at the market, and each day that passes by that we haven't found a nice definitive low. We had the makings of a low 2 days ago, and we had some follow through yesterday on the upside, and today we had a stall day. Now, maybe it's just a stall day, and maybe we take off to the upside tomorrow, and that's perfectly fine, and that supports the overall bigger picture case that we should be finding a low and we should be rallying for the next, 6 to 8 weeks. However, we are in options expiration week number 1, and that means that the institutions will whip the market around in one direction or another. And I think that's part and parcel to what we saw this morning. So that's not that unusual. We have earnings, so earnings can certainly send a spark to the market in one direction or another. We should know in short order which direction is going to be the short-term prevalent direction, and we should know in short order. I'm just bringing to the forefront below the moving averages and trading around the levels we are without some follow-through from yesterday has me a little bit suspect on the market. Nothing more, nothing less. Whether we go down first and then find a low, or we've already found a low, either way, the bigger picture, it doesn't matter. We still have, in my estimation, one more leg up in the market. And so nothing's really changed from the bigger picture perspective. I just wanted to give you the shorter picture perspective. And when you look at the 60-minute chart also, just point another thing out or two. So we had a normal garden variety retracement from this low to this high. The retrace down here was about 618. I don't even have to measure it. It looks to be about that much. And then we had a bounce off that level. Now, what's happening now is that we're inside this red candle, and until and unless we can close above the high of that red candle, the market will still be a little stymied. The high is 234.06. We tried it a couple of times today, 234.15, 234.15. The problem in my mind at the end of the day today, there was no reason the market could not have gone higher. Usually at the end of the day, the magic hand comes out and the market just has an end of the day ramp. They could have done that today. They could have closed above that red candle, and they could have pushed it into the 50-period moving average up at 234.45, 234.50. They could have done that very, very easily in the last few minutes of the day, last half hour of the day, but that didn't happen. And again, that leaves me a little suspect. And that's it, just for nothing else than giving you my thought process for what it's worth, and we'll see how it works out tomorrow. Going over to the IWM. The IWM had a little bit of a better finish on the 60-minute chart than did the S&P. However, we're into the 20-period moving average on the weekly chart, and again, the same routine. We're inside this bearish wedge pattern, and generally speaking, this will play out to the downside, but my time cycles have us making a low and should have made a low. We're in that zone. And so, again, we have conflicting data. I have conflicting data, and we're just going to take it one day at a time. Certainly a positive sign will be a close above the 20-period moving average, preferably tomorrow. That could at least get some kind of fire under the market, at least from the IWM perspective, and lead us a little bit higher. The IWM still was somewhat of a leading indication today. It was leading, it wasn't up, but it was flat, and flat was better than the S&P because the spider was down 72 cents or 1/3%, and the S&P cash index was down about the same 1/3%. So the IWM was certainly the stronger index, but you can't really take much away from it. It really wasn't that strong. It was just flat. Looking over at the VIX, we did see some follow through to the downside in the VIX. And even with the market down today, that is a positive sign for the upside in the market. Since there was no fear in the market, even while the market was down, the VIX was up earlier today, but even though the market finished down, some air came out of the VIX and we finished near the lows on the VIX. That's definitely a positive signal, if for nothing else, that the market has some upside in it, meaning the stock market. If there was real fear out there and the market finished very poorly today, the VIX wouldn't have finished where it did. When you look at the short-term chart of the VIX, or at least even an hourly chart, you can see here that we were in a downtrend on an hourly basis, and on the 10-minute chart, you can also see this was in a downtrend, and that tells you that even though the market finished down today, it certainly was off the lows, and there was no fear coming into the market at the end of the day. That generally will spell some kind of upside momentum rather than downside for the stock market in the near term. On the transports, we didn't do much today in the transports. We were down hefty early on, but we recovered some of it. But it was an inside day to yesterday. There's not much you can make out of an inside day. Inside meaning the highs of today and the lows of today were inside of the highs and lows from yesterday. And really, that's a nothing day. We're not going to make one thing or the other out of the transports. It was just down 0.6%, 57 points, kind of in concert with the fact that most of the markets were down today. We're not going to read much into that. What else do we have on the docket? Take a look at the NASDAQ 100. No big deal. It was down $3. Nothing one way or the other. It was positive if for nothing else because it could have been down more. It was down more earlier and did recover. But again, you know how I feel about that. It's a very top-heavy weighted index. Therefore, I like my read better from the IWM, and we'll leave it at that. Still trapped in between the moving averages on the NQ, so nothing really happened since yesterday. We can't get a read one way or the other. I do want to talk about the financials today. We'll bring up the XBD, which is the broker-dealer index. Was only down 67 cents. It was certainly down a lot more earlier in the day. But there's a couple of things I want to bring to the forefront that are important. Forget the broker-dealer index. Let's look at Goldman Sachs. So Goldman Sachs got crushed today. It was a morning gap trade for those of you that are in my gap trading course. My gap trades in the morning. We had a good one in Goldman today. And Goldman was down $10 or almost 5%. That's a big deal for Goldman Sachs, okay? You can see that this bearish pattern did play out, or maybe not complete yet. I probably would rather see Goldman down at 210. That would be a good buy down at 210. Anybody interested in Goldman? That would complete, or excuse me, more so complete this pattern on the bearish side. But the reason there's a method to the madness, the reason I want to bring this to the forefront is Goldman Sachs was down. JP Morgan was down. Bank of America had earnings and it was up early and it finished slightly down. Okay, so it was up into the 20-period moving average and had an intraday reversal. You can see what happened here. That's not a positive sign. Wells Fargo, which is one of the other leading bank stocks, was down. Now this isn't, this is a 10-minute chart. We'll look at the daily chart. So this has been struggling of late. It's into the 200-period moving average, but if it goes sideways, it's going to go lower. We don't need these lines. It's going to continue to go lower unless it can catch a bid with the rest of the market. But therein lies my point is, and I always say this, without the financials, the market can't catch a bid, and the markets and unless the market catches a bid, the financials aren't going to catch a bid. It goes both ways. Anyway, the point is that the financials were under some pressure today, namely with Goldman Sachs. And if you look at the Dow is down 113 points. And I don't know exactly the number, but I'm pretty sure that Goldman accounts for at least 40 or 50 points of that, or 30 or 40 points of that. So the Dow wasn't even as bad as it looked on paper because of the one big hit from Goldman Sachs. But the point I want to make is you need the financials to participate. And so far they haven't. And so far the market's been stuck in the mud. And without the financials participating, it's going to be very, very difficult for the market to get off the mat. If we look at the XLF, which is the other financial sector spider that we look at, it looks very much like the spider. But there is something I want to point out, and then we're going to go back to the broker-dealers, and I'll point that out as well. You see this pattern that looks very similar to the spider. The problem is that we breached this low that we did not breach in the spider, and we closed below it. Now, I think that generally has some significance. We're in a downtrend. We're below the moving averages, and that is not necessarily the end of the world, But generally speaking, that's not a sign of positive behavior. And so I think that's of note. I think it's worth, just worth realizing that that did take place and that could spell trouble ahead. And that, coupled with the fact that Goldman got hit and the financials can't get off the mat, is interesting. When you look at the broker-dealers, again, not the same pattern as the spider, certainly much weaker than the spider. So they came down, the broker-dealer index came down much more than the spider. When the spider was making a higher low, this was making a lower low from this low here on the 27th. So I thought that was interesting to bring to the forefront. We're going to keep our eye on that. And now we're going to move on to gold. So yesterday we were talking about the fact that gold was possibly stalling out, and it really wasn't closed for the day yet. It was closed on the pit session, but the entire day wasn't closed yet. And then it ended up finishing with a doji candle, and we had a nice update today. And what's interesting is this is just going sideways. And again, we talk about canary in the coal mines all the time. And the question is, if the market was really going to rally, and since gold has had, of late, an inverse correlation to the stock market, wouldn't there be some kind of a tell? Wouldn't there be money coming out of gold if the market was getting ready to rally? Maybe not yet, but that's the way I'm looking at it. I'm saying until money starts coming out of gold, I'm thinking that there's some kind of a bid underneath gold for a reason, and we're talking about different reasons there could be trouble in the stock market. I'm not suggesting all these are pointing to a down stock market. I'm just saying that we may not be done with the downside, and that may be what gold is telling us. And when we get to bonds, we'll have another discussion just like this one. So gold's going sideways, still has a bid underneath it. And silver, when you look at that, it was down slightly today. But again, we're in this upper range, tried to come down earlier, bounced off of it. As long as we remain above the 200-period moving average, this is still building energy to get through this area. We're not going to make too much out of today's activity. It was just back and forth. But the point is that when these metals and bond market and other markets tend to be telling us something, you want to pay attention. And that's what's happening. They're telling us something. We learn to speak a different language when you look around the markets and you utilize various activities in different markets to our advantage that seem to happen or repeat over and over and over again. And we learn over time that these are normally tells of something to come. Maybe not tomorrow, maybe not Friday, but the point is that generally speaking, certain things generally tell us something is coming. And that's why we look for evidence all over the place. We'll get to the bond market in a second. First, let's take a look at the crude oil market. And we talked about this, no surprise to anybody. The crude oil market is coming down. We talked about it coming down to the area it's in now. We talked about this would be the first level of resistance, or pardon me, support down here at 52.75. We're at 52.78. That was an obvious one. The next area is around these moving averages. And so that's the way it works, is these markets go up and they go down in sequence. They find levels of support and then they, banter around for a few hours or a few days. They find another level of support and the same thing happens on the flip side. And so right now, we could trade around here for another day or so, or we can come back into the moving averages down to about 52 would be a nice area that you would likely see a more pronounced bounce in crude oil at around 52, 51 to 52. 52 should provide a decent level of support. If we go through there, 51 would even be more so, with this green candle and the 20-period moving average sloping up into it. So crude oil acting pretty much as anticipated. Now, when we look at the bond market, I thought yesterday the bond market had a chance to have been putting in a reversal signal. That turned obviously not to be the case. Okay, look what happened today. We took a rocket higher. We're almost at the number that we talked about a few days ago. Last week we put the line in the chart, 155.20. The high today is 155.16. whether we hit 155.20 or not, we're pretty much there. We're close enough to where I would consider that a direct hit. Maybe we go a little higher, maybe we don't. But this is an area where two things happen. A, we start looking for a top in bonds. But B, we have to be aware that money is coming into the bond market for a reason. It's coming into the bond market not because people want to own treasuries at next to nothing yields. That's not why money comes in the bond market. It comes to the bond market to hide out. It's just a place to park when money wants a place for safety. And if money's coming out of the equity market, going into the bond market, and the bond market was up another over 1% today. These are big moves in the bond market. I mean, look at the move you've had from here to here. This is tremendous. We talked about 158, 159, 160. We talked about these numbers down here. We've been talking about these numbers for quite a while. Here we are. Now we're at 150, almost 156. Anybody that was long the bond market from when we started talking about it down at 150 or even below that, you have to be exiting the position. Don't hold out for the last couple of points. Leave a trailer if you're in a TLT or something like that. You leave a little bit on, but you take half or 2/3 of the position off up here because you may not get the full Monty out of the position. Maybe it doesn't go all the way to 160 or 159. If you got this much out of the trade, you have to take half at minimum and put it in your pocket and see what you can get out of the rest. But you should stall out here in the bond market here pretty soon. I can't imagine we just run straight into the 200 period moving average. And if that's happening, the stock market is selling off. That much I can tell you. It's a wonder the bond market's been rallying like it is, and the stock market really has been stagnant. That's a little bit of a head scratcher too. And I always tell you, the bond market participants are much more intelligent. They're smarter than the stock market people. Generally ahead of the game, but the bond market's been ahead of the game for a while. So something's brewing out there, and we'll find out soon enough what it is. And with that, we'll move on to the dollar. And the dollar had a little bit of a downtick today. And as you can see, we're headed now all of a sudden towards the lower end. Well, we're not there yet, but we're in the direction of the lower end of the channel. First will be the 200 period moving average, and this pivot low will certainly provide some level of support for the market. But if we come to this lower level of the channel, depending on when we get there, if I move this over and you just fast forward and say this is going to take a while to get there, maybe it takes, till, I don't know, end of May, June. Does that put at 97 at the bottom end of this channel? That is possible. So we'll see how this plays out. This may be very interesting to see how the dollar plays out, and when it hits that number, if it hits that number that we've been talking about, or I've been talking about for a long, long time, around 97, that will be an all-out buy area, but it'll be interesting to see how it plays out within this channel as well. And with that, I'm going to wrap it here tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.